In this video, I'm going to show you how you can short almost any asset, and I'm going to show you how you can short it multiple ways. Because if you only know how to make money when the markets are going up, at the very best, you're missing out on half of the directional movement that a market can make. And number two, at worst, you are vulnerable to market crashes and losing money when markets go down. And so it's vital, if you want to make the most amount of money possible investing, to understand how you can make money when the market is going up, as well as when the market is going down. If you don't know who I am, my name is Joe Brown. In 2019, I quit my job as a stockbroker so I could start Heresy Financial, where I teach people how markets really work so you can make more money investing. So first, let's talk definitions. What does it actually mean to short something? There's going to be two different ways we're going to look at this. The first way is what people normally mean when they say, hey, I'm going to short something. Really what they're saying is, I'm going to position myself to profit from this thing going down in price. Because normally you're only going to profit if you buy something and it goes up in price, you can sell it for more later. That's what most people think of when they think of investing. So somebody takes a little bit of a next step, gets a little bit more advanced investing. They say, well, I'm going to position myself so I can make money if it goes down in price. A lot of times they're just going to say, hey, I shorted it, but that doesn't always mean they're actually shorting it. If that doesn't make any sense, don't worry, I'll explain that later, how you can actually profit from something going down in price without shorting it. Okay, so what does it mean to actually short something? Well, first, let's talk about buying something. You have dollars and you are going to exchange those dollars with somebody else for something that they want to sell to you. Maybe you're buying gold, maybe you are buying stocks, maybe you're buying real estate, maybe you're buying a car, anything you want. That makes sense. What also makes sense to a lot of people is selling something. You own something and you're just gonna sell it to somebody else, which means you are exchanging that item for money. Now, the buy and the sell are both actually describing the same process. Money and a good are changing hands. Whether you call it a buy or a sell just depends on whether you are the person receiving or giving the money, or receiving or getting the object. So buying makes sense, selling makes sense. Short selling takes it a step farther, because when you short sell something, you are selling something that you don't actually own yet. So how do you sell something you don't own? Step one, you have to borrow that item. Whether you are short selling shares, you are shorting the dollar, or shorting something else, it means first you are borrowing that item. Step two, you are going to exchange that item for something else. Step three, you will exchange items back. And then step four, you will pay back exactly what you borrowed. If that doesn't make sense, do not worry. We're gonna go into a couple examples that'll make it crystal clear. First, let's use the simplest to understand example, an iPhone. Let's say you have a secret inside tip that Apple's gonna come out with new iPhones this year. And you're the only one that knows this. But your buddy has an old used iPhone just sitting on his shelf in his closet that he's not using. So you're gonna go to your buddy, you're gonna say, hey, can I borrow your iPhone? He'll say, sure, fantastic, just give it back to me when you're done. You say, perfect, I will. You borrow it, you list it for sale on eBay, and you collect $1,000. Now at this point, you have borrowed an iPhone and then you have exchanged it for dollars. You're only halfway done though, because the transaction's not done yet. You still owe an iPhone back. And that's important to remember. You don't owe your buddy dollars, you owe him an iPhone. That's what you borrowed. So your transaction is halfway done, you've made the sale, and now you just have to wait until the price of used iPhones comes down when the new iPhone is released. And sure enough, Apple comes out with a new iPhone, all the old iPhones go down in price on eBay, you buy the exact same model that you previously sold for $1,000, now you buy it for $700, and you give that one back to your buddy. It's the same exact model that you sold, you deliver it back to him, and now your transaction is closed. You borrowed an iPhone, sold it for $1,000, bought it back for $700, delivered back the iPhone that you borrowed. That is a successful short sale. Now you can see how this applies fairly easily to financial markets. If you want to short the shares of a stock that you think has a good chance of going down, you just follow the same four-step process. Number one, you borrow the shares. Number two, you sell those shares. Number three, you wait for those shares to drop in price. And then number four, you buy back those shares at the lower price, deliver the shares back to who you borrowed them from. Now, it's important to remember that this process is almost completely automated. All you're gonna have to do is log into your online stockbroker, you're gonna click sell short the shares, and then later on you're gonna buy them back to close. You're not gonna go through the manual process of borrowing them and delivering the shares back. The only caveat to that is if the shares are already highly shorted, which means so many people want to borrow them to sell them short already that it's hard for your broker to locate the shares, you may have to do some manual work. You may have to sign an agreement that you're willing to pay an interest rate in order to borrow those shares. In that case, probably a good idea to stay away because you're at the risk of a short squeeze anyway. On the flip side, if you own shares that are already heavily shorted and are hard to borrow, and you're gonna own them long term, you can ask your broker to participate in their securities lending fully paid program, which means you're gonna hold on to them and allow other people to borrow them from you so that they can trade them and you'll collect the interest rate that they're paying. Nice little way to make a little bit extra income on shares that you're holding for the long term anyway. But it doesn't stop at stocks. You can also short pretty much any asset class. In this case, the example of currencies. Most people are not aware of this, but whenever you borrow dollars in order to buy something, technically speaking, you are shorting the dollar. Let's go through those 4 steps again. Number 1, you borrow something, in this case, dollars. Number 2, you exchange them for something else. In this case, let's say a car. Number 3, you exchange that thing back again. Let's say you sell your car. Now those dollars are freed up and you pay back those dollars that you borrowed. Now, the example of the car highlights an example of what's most likely an unprofitable short, and I'll explain why. For a short-term trade, when you're shorting shares of something like a stock, really the only thing you're looking at is the price of the shares. You're not ever really gonna have to take into account the value of the dollars themselves. But the longer the time horizon of your short, the more you are going to want to take into account both sides of the equation, which means that when you have a long-term short, which is, a long-term loan on dollars, that would be an example of a long-term short, you really have to take into account the relative difference in value between the thing you're shorting and the thing that you're buying in the meantime. For something like an auto loan to buy a car, many times the car will depreciate faster than the currency will, which will mean you'll end up with an unprofitable trade once you unwind it. However, with other asset classes like real estate, if you borrow with a fixed rate mortgage for 30 years to buy a piece of real estate, especially if it's an investment property and it's cash flowing for you and paying for the debt, many times the value of that property will appreciate, but even if not, it'll depreciate slower than the currency that you use to borrow it. And this is a little known fact about many investments, that they are only profitable because they are paired with a short of a currency like the dollar. Especially real estate. Real estate by itself has been a pretty subpar investment, even in the United States, over the past 100 years or so. This is something Lynn Alden pointed out in one of her recent articles, that going back to 1890, the nominal home price in the US increased about 88 times from 1890 until today, while gold increased 123 times. But if you pair that asset with a short on the currency, you are profiting off of both at the same time and turning it into a very profitable investment together. So now let's look at a couple major asset classes and see how you can not only short them, but also just profit from them going down in price if you don't want to go through the hoops of actually shorting them. First, let's look at stocks, the overall stock market, and ETFs. This is gonna cover probably 90% of anybody's needs in order to short really anything. So the first thing you can do is actually short them. Like we went through the whole entire process where you borrow the shares, you sell them, if and when the price goes down, you buy those shares back and you deliver them back. The risks with this are, number 1, you might be wrong. If the price goes up, you still have to buy those shares back and deliver them back, but now you're buying them back at a price that was higher than what you initially sold them at, which means you lost money. And since a stock or shares can theoretically go up an unlimited amount, this leaves you with unlimited risk to the upside, potential unlimited loss, if you are not hedged by doing something like buying long calls. You also want to make sure that you are watching out for heavily shorted stocks or hard to borrow shares, as those could leave you vulnerable to a short squeeze, as most people are familiar with now that things like GameStop and AMC and other meme stocks have had multiple short squeezes in the last couple of years. The final note, if you're going to short any shares, is you are going to need a margin account, as you are actually borrowing something and then selling it. You're going to need margin approval on the account. It doesn't mean you're actually using margin and paying the interest for using that margin. It just means that you are going to need a margin account so that you are approved to borrow things in your account. The second way is to position yourself to profit from a decline in the price of the shares, just like short selling would, only this time you're going to do that with buying puts. These are an option contract that gives you the right to sell the shares at a certain price during a specific amount of time, which means if you buy a put and then the share price falls, well, you make money because that contract is now worth more. You can either exercise it, sell the shares up here, buy them back down here, or you can just sell the contract for more than what you bought it for. Options do have a little bit of a learning curve, and if you don't know what you're doing and you jump in too quickly, then you can get yourself into some trouble. So I don't recommend jumping in until you really understand what you're doing. I spent a lot of time teaching people how to use options in Heresy Financial University. I'll tell you more about that later if you're interested. And the third way to position yourself to profit from a decline in the share price would be with inverse ETFs. Although I usually recommend staying away from these for anything other than a day trade. This chart that you're looking at is an example of an inverse ETF, which has the daily performance that is directly inverse to the S&P 500. And you can see it does nothing but go down from the top left down to the bottom right. As we zoom in on shorter and shorter time frames, we see that it still does nothing but go down and to the right. Yes, there are very short periods of time where this thing will rise, but holding this over any sort of a long time horizon opens you up to massive risk. And no matter what the market does, it will never be back up to where it used to be. The reason for this is because the way all inverse funds are designed is to track the daily performance. This is true with leverage funds and inverse funds. And because of that, you have something called beta slippage where they lose value over time. This is the way that they're designed. And if you don't know what you're getting into before you're getting into them, you're most likely going to lose everything that you put in. When I was a broker, I can't tell you how many people I interacted with, how many clients I talked to that didn't understand how these things worked and that they were designed to be very short-term instruments so that you could profit from very, very short-term trades. And they put themselves into these, the market would crash, 10, 15% from something big, and they'd be nowhere near break even and just, beside themselves because they realized they're never going to get their money back. And this is true of all inverse funds and all leverage funds. They all do this. So stay away or proceed with extreme caution. Now, what we just covered will cover you for basically any asset class, whether it's stocks, real estate, gold, crypto, because for all those asset classes, you can find publicly traded securities that either mimic or invest in those asset classes. But just in case you want something a little bit more direct, let's do that now, starting with real estate. First off, I want to clarify that in real estate, when you have a short sale of a home, that is not the same thing here. It is similar to a foreclosure. You own a home, it's worth less than what you bought it for or what you owe on it, and you're selling it. In a short sale, the bank agrees with you and they just say, okay, yep, you're going to sell this home. You're going to give us all the proceeds and we're either going to forgive you the rest of the debt or we're going to, figure out a way for you to pay back. So it's technically similar because you are selling something that you don't own, but the mechanics are very different. With a short sale of a property, you are not borrowing it first, selling it, then buying it back and then delivering the product. It's completely different. I don't know why they're called the same thing. Maybe it's just because you're selling something you don't own. Maybe it's because when you sell it, you come up short. So it's called a short sale. I'm not sure. It's not the same thing. Alternatives with real estate, like we just covered, you could short sell shares of REITs, real estate investment trusts. You could also buy puts on those funds, or you can engage in wholesaling. Again, this is not going to be exact, but wholesaling gets you pretty close. If you're not familiar with wholesaling, it's where you find a property that you want to buy because it's a good value. You've got it at, under market value. You put it under contract, and then you take that contract and you go to somebody else, like an investor, like a fix and flipper or a, long-term holder or whoever, and you say, hey, I've got this property. I'll sell it to you for this much. And so on the day that the transaction closes, both transactions are happening simultaneously at the exact same time. You are purchasing it for, let's say, 150 grand. You are selling it for 170 grand, and you're keeping the spread, the $20,000 spread. Again, it's not exactly the same because you are not borrowing it and then selling it and then exchanging it again and then paying it back. But the end result is pretty similar. You are going to be able to get something locked down for a price that you're selling above the price that you're buying it back, and the transactions are happening at the same time instead of one in front of the other. Now let's talk about precious metals. If you want to short precious metals, again, you can do the same thing that we talked about with shares. You can short shares of GLD or gold miners or SLV or any other ETFs. You can buy puts on those shares. But many people are not aware you can actually do this with the physical metal itself. And no, I'm not talking about borrowing or lending dollars using precious metals as collateral. That is a service that many companies offer. What I'm talking about is borrowing the metal itself. While most people watching this video are probably not going to want to participate in borrowing gold, it can be done done. A company that I am invested in and that used to sponsor this channel is Monetary Metals. And they have established a marketplace between people who want to lend their gold and then companies who need to borrow gold. For certain companies, like let's say a gold miner, it makes more sense to have their debt denominated in gold because they know they can get a certain number of ounces out of the ground. And so it de-risks that loan for them. They just get the loan. Now they can get the gold. They can pay it back. And then for the lender, it makes sense as well because you actually grow the number of ounces you have. You don't care about the price fluctuation. And so for those companies who are borrowing gold in order to fund their operations, that is actually a short on gold. Next up, let's talk bonds. Let's say you are interested in profiting from the price of bonds declining if and when interest rates continue to move higher. Well, number one, you can do the same thing that we've done before, which is find an ETF that invests in bonds like TLT, which tracks the US 20-year treasury, and you can short those shares or you can buy puts on those shares. The other thing you can do is you can trade futures on treasuries. Futures are derivatives similar to options. Next, let's talk crypto. Yes, you can actually short crypto. I do want to make a big warning here. Please don't. Very, very high risk. You actually can borrow the crypto and you can sell it on the exchange the same way we talked about with all of the shares. It's very risky because again, number one, crypto is a lot more volatile. Number two, there is no upside to prices. They can theoretically go up an unlimited amount. So when you're shorting something, you've got to have a way to cover your risk. That's why I like doing it with shares on publicly traded markets because you can buy calls in order to hedge your short position. You're not going to be able to do that with something like Bitcoin. Now, very soon we will see options start to trade on some of the new Bitcoin ETFs. They're not trading yet, but at some point when they do, that will allow people to have a mechanism to short crypto or Bitcoin. You can short the shares of some crypto ETFs, although many of them are still considered hard to borrow. If your broker can locate the shares for you, you might have to pay a hefty interest rate on it. And then finally, the big one here is dollars or shorting your currency. And this is the one that many times turns investments into profitable investments because you're pairing the profitability of one thing going down that is pretty much destined to go down with something that will go up that is priced in that thing that is going down. So by pairing a short of a currency with an asset denominated in that currency, especially when the 100-year-long history of that currency is just going down in a straight line, that makes for a pretty profitable pair. And basically the investment or the asset is there to serve just as a vehicle to support, be the collateral against the short of the currency. And remember, it's the relative difference between the currency and the asset that matters. If the asset depreciates faster than the rate of inflation, it's a bad trade. If the asset doesn't pay for the debt service cost of the currency short, it's a bad trade. Remember, whether you're shorting dollars or shorting shares, sometimes you have to pay to borrow that thing. And with dollars, you usually do. Because if anything is destined to go down in value, you're probably gonna have to pay an interest rate to borrow it. That's why shares that are hard to borrow because most people expect that they'll go down. And so you gotta pay an interest rate in order to attract somebody to lend you those shares. Same thing with dollars. And finally, if the debt is variable interest rate debt, it is a bad trade. So borrow fixed rate debt, use that to buy assets, preferably that pay for the debt service cost and that depreciate slower than the depreciation of the currency. And together then you have a good paired trade. And if you want more, there is a ton more where this came from and how to apply it and fit it into an overall portfolio strategy. Heresy Financial University is a place for you. If you're not joined yet, what are you doing? Check it out in the link below. You're going to learn everything you need to know about growing your money, protecting your wealth, investing, trading. All the financial education you need is waiting for you. Check it out. Link is in the description below. As always, have a great day.